Welcome to Nerd Stock Talk. This is episode 7, and we are recording this live on Saturday night, 8 p.m. Eastern Standard Time. So for those that check this show out as it's recorded and uploaded later, come on in anytime, 8 o'clock Eastern Standard Time on Saturday.
Anytime as long as it's 8 o'clock Eastern Standard Time.
I am your host, Barney Smith of StoryComic.com, and with me is my co-host, JP Redshirt Wildman. JP, how'd it go this last week?
Do you want to talk about something else?
So, like we do, we always like to start off right away, just kind of like start talking about how our previous week's stocks did. So, and JP, what we always like to do is like to see who did the worst and go back to who did the best. So, JP, let's check out what your long pick was.
We don't have to.
All right, so looking at that, so Canoo, that's still your long pick. So what's going on with Canoo?
Yeah. Well, this is a short-term 28% correction. Short-term. The market didn't do so well last week. Just about every tech stock really dove somewhere between 14 and I've seen some drop as low as 40% last week. I don't think this is a long-term dip. I think it's going to come back rather quickly, and this is a very good time to buy those stocks. I think.
Yeah, as you said, like buy the dip. We said it before. Buy the dip, and so real quick. So, and also you mentioned Ferroglobe was you're looking at Ferroglobe last week, and that seemed to have fell down by 24% too.
Yeah, well, Ferroglobe is a pretty small cap stock.
Okay.
So when the stock price is only in the $3 range, it doesn't take much. I mean, that stock will move 10% a day.
Right.
So 24% isn't. I'm not too worried about Ferroglobe.
Right.
I think long term that's a good stock. There's new tariffs on silicon and all sorts of other minerals that are used to make solar panels and things like that, which is what Ferroglobe is in the business of. So those have higher tariffs now on the imports, which means domestic production is a little more lucrative. So that's the play there. The reason all of these tech stocks, including all the way up to Tesla, this is nothing unique to any one particular company. The reason is a lot of the institutional investors were into these tech stocks because the returns were so high. And last week, bond yields, U.S. Treasury bond yields went up. So that meant that you could get more return for much less risk. So it became more attractive to move that money over into U.S. bonds. Now, this is something that institutions do quarterly. And so this was one of those rearrangements that they do.
And we can talk about that for those that for tuning in. I mean, so there is people always hear the term, I remember like watching like Saturday morning cartoons with like the big guy with the money bags. I remember Looney Tunes or something. You always hear about stocks and bonds. And now that I'm starting to understand it, stocks, we've been talking about stocks because this is Nerd Stock Talk, but there's also the episode, there's bonds, and bonds is basically, correct me if I'm wrong, JP, but bonds is like you loan money to either a company or you have treasury bonds where you can loan money to the United States, and you would get an interest in return. You would get 3% interest or 5%, whatever that interest is based off of whatever year, whether it's a 1-year bond or a 5-year bond, or that's basically how it works.
Yeah. So the Treasury will issue bonds at a given rate. That rate up until last week or so was stupid low, like almost nothing.
Right.
So there was no incentive to buy a bond.
Right.
So all that money was looking for a home, and it found its home in some of these tech plays. Tesla was one of the big ones. It was one of the main drivers of the Tesla price. Tesla, even though it's an attractive stock and performs very well, the underpinnings of the company don't really live up to its stock price, and
Right.
part of the reason for that is there's a lot of speculation in it.
Right.
And some of that speculation is starting to pull out and pull into bonds, which are a much safer investment.
Yeah, and also too, it's just almost the same thing when we talk about stocks, is like high risk, high reward. So if there's those speculative markets, you're like, hey, this is going to be a good return on investment if this pans out. Same thing with bonds. Like you have a higher interest rate for a company that might not do too well. So you might have a higher interest on that you could get in return.
Right,
So,
right. You can make 1% with absolutely zero risk. That is better than making 5 or 6% with the risk of losing, 50 of it.
Right. And so that was that's what I was looking. So basically the stock market, mostly, as you said, most of the technology stocks that were more the speculative stocks took a hit last week because of the bond yield being higher.
Yeah,
so
and it really hurt my feelings.
So I tell you what, so Tencent, it's still there. It was only down 8%, but this was a tech stock. This is also, it's a mobile gaming company. But I told you last week, I said, ViacomCBS Paramount Plus was going to be launched on March 4th. And that stock was a 14% increase on there. And you did mention before we went on the air that you're talking about the RSI indicator. So we'll probably talk about RSI indicators maybe next week or the week after, just to kind of give people what that means. And RSI stands for, again?
Relative Strength Index.
Okay.
It's one of the tools that day traders use to know when to buy or sell a stock throughout the day.
Okay.
It's kind of based on volume and price. And there's a bunch of other calculus equations that go into it. But essentially, once it hits a certain point, that's a good sell signal in it. And it's accurate about 85% of the time.
Right.
Right now, Viacom is touching that sell signal.
Okay. Because it probably, and that's what I'm thinking. It had a peak because of the launch of Paramount Plus, but it'll probably even out again. So that might be something.
And probably a lot of folks were thinking exactly like you.
Yeah.
I'm gonna buy this because they're launching Paramount Plus. Now the price is over and above what is justified, business wise, by how much they're going to make on the launch of that. So people are going to start to sell it off, and it'll stabilize. By and large, if Viacom will grow, say 5% a year, a 14% bump is not sustainable. It's going to be corrected. And it'll probably drop another 10%, and then it'll go up another 8%, and it'll carry on like that until the average becomes 5 or 10%.
Yeah, and it's at, I think I said it's at around $74 a share. I am confident that it will never, and as I said last week, it'll never be a Disney, which is always knocking on $200 a share right now. It'll never be Netflix, which is about over $500 a share. I see this more or less around the same level as AT&T right now, where that's owned by that Warner Brothers and HBO Max as part of that parent company is AT&T. I see that probably where it's going to end up going towards. So
yeah. Oh, Viacom's a pretty strong company. I mean, I don't think there's any qualms about it. I think if you want to maximize your returns on that, sell it for a day or two, and then buy back in on like Tuesday or Wednesday. I think you'll see it'll recover kind of in between the low point and where it is now.
Well, I mean, the stocks I bought off it, I basically was able to pay for my year subscription of Paramount Plus, so I'm fine with that. All right, so
it should be illegal.
Yeah. All right, so let's move on to tonight's topic. So tonight's topic is, so we've mentioned in previous shows, we've been talking about index funds, we've been talking about ETFs, we've been talking about mutual funds. So what we really wanted to do, episode 7, we really just wanted to focus on just kind of give people a broad understanding of the differences between mutual funds index funds and ETFs. So basically, what you'll see, and we have a thing that we can pull up for you, is these are the differences. You have your main three ones, and each one has its benefits. Each one has its drawbacks. The benefit of a mutual fund is first of all, it's actively managed. It's the most accessible type of fund you can get through your friendly neighborhood financial advisor. And what this does, if you sit down with your financial advisor and they'll ask you a series of questions, basically they'll say, what are you looking for? Do you consider yourself high, do you like risk, or are you more conservative with your thing? So there's a questionnaire that your friendly neighborhood financial advisor will ask you. And what they'll do is say, all right, for instance, you say, listen, I'm just going to get enough money to, buy a house or get a car, or the retirement is basically, your 401k or your 403b. Those are going to be kind of the points of the mutual fund is going to aim to meet a specific objective. And the benefit I would also for this is that there is an actual person who manages the funds that you have on there. So if you're the kind of person who keeps saying, I'm not going on the self-checkout, I'm going to go through the checkout line because you know what? Those are people's jobs and I'm not going to take away jobs. So this is the benefit of a mutual fund, is that you actually have a living person behind the scenes who is actively managing your portfolio, basically. Your
and in terms of risk, it is probably the lowest possible risk you have in getting into the stock market and investing, because you have professionals managing the portfolio, mitigating the risk. They have all the indicators up. They know which stocks to buy and which stocks to get out of and reallocate the funds. So if you really don't want to lose any money in the stock market, a mutual fund is the way to go. Not that you won't lose any money, but as I always say, you don't lose until you sell. So a mutual fund is the safest play.
And I would say too, to add a caveat to this, if you go watch any YouTube video or you watch anything where they're actually talking about the benefits of this, you will see, I gotta say, objectively speaking, you'll see a lot of people who are very critical of mutual funds. I am not going to be critical of mutual funds because, first of all, I think, JP and I have friends who are financial advisors. So, I'm not going to feed, and I have a financial advisor, and we keep telling people, go to your financial advisor. We're not financial advisors. And so with that said, the drawback of it is there are higher fees with that, because you are, whether it be 1% on that. So 1% of your funds for a year doesn't seem like a lot of money, but that will add up over time. But that's where it comes into that.
And that's so boring. Gosh, they're boring.
So with that said, there are benefits, there are drawbacks to mutual funds. Now, index funds they're passively managed, and what that means is that they basically kind of mimic the S&P 500 or the Dow Jones Industrial Average or the S&P 500.
All of the stocks involved in the particular index that you're investing in. So the Dow Jones or the S&P or the NASDAQ,
right. And it just basically, as it says, it basically what it does is basically it's passive, and what it does is supposed to make sure it grows as the market that it's connected to grows.
Right.
And
there were index funds last week that were down as much as 30%. But overall, the stock market was not down 30%. I think the stock market ended relatively flat, if I'm not mistaken, maybe down 3% or something.
It did end up pretty flat, yeah.
Yeah. So if you're in an index fund in the Dow Jones, and while an ETF or some other funds may have been down, if you were in the index fund, you would not. You'd be flat because you're investing in the entire stock market.
Right. And what index funds have as well is index funds can be kind of quote unquote themed in a way where, you want to have, everything in technology stocks or everything in finance stock, or whatever it is.
Yeah.
And as we say, all of these things we're talking about here, what makes these different than specific stocks? As we mentioned a couple of weeks ago, think of them as like a Chinese restaurant buffet. It's basically as you get plenty of different stocks in one big pile, and you're only paying for a portion of that. So
I currently hold a couple of index stocks in NASDAQ called SPLG, which are all the small cap companies, all of the the smallest 50 companies, I believe it is, on the NASDAQ exchange, which is sort of like investing in all of the rice dishes on the Chinese buffet,
And so that's the difference between mutual funds and index funds. Index funds and ETFs have more similarities as well, because ETFs are index funds that you can trade
like a stock.
You can buy them on there. Index funds you cannot trade like a stock. They only can be traded once a day after hours. So, and you might see that index fund might be going low, and you want to buy it at 10 a.m. or the best time you want to buy it. You can't. ETFs can be traded as stocks. So personally, what I like about ETFs is that you can buy them on their dips daily. You can see how it goes down, and you can buy them, which is good.
The interesting factor on an ETF, though, is that unlike index fund and mutual funds, ETFs they track the movement of the stocks they're comprised of, but there's also that supply and demand and that market component that can drive the price to diverge a little bit from what the underlying stocks are actually doing, which is the interesting factor. Folks will buy into an ETF, and if there's a lot of hype on that ETF and a lot of buying that day, the price of that ETF could actually go a little higher than the underlying stocks, or move more than the underlying stocks do. So it's an interesting factor to it.
Yeah, and like I said, the benefit of an ETF, say for instance, like the stocks that we were just mentioning, like just like hypothetically speaking, there's an ETF or an index ETF that has the stocks we just mentioned: Ferroglobe, ViacomCBS, Tencent, and what was your other? Canoo. Let's say for instance, there's an ETF that has those three things.
The nerd stock talk ETF.
The benefit. So the thing is that ETF is going to be worth a little bit more, because there's still a management fee inside ETFs. It's not as large as a mutual fund, but there is
somebody has to put that stuff together.
Right. So the benefit of buying that there, you basically buy all four stocks with one ETF, with one purchase, with that one fund. But if you buy them directly, those four stocks, it'll cost you more, and you're a little bit more in control, but it costs you more money, and it makes it a little bit harder. So that's basically the difference between the three of those. Each one has its own benefits. Each one has its own drawbacks. I personally, I like index funds, because those are the kind of set it and forget it deals where you put that in there. ETFs, for those day traders, the temptation of selling and buying and all that stuff happens so quickly that it's for those people that might have some impulse control issues. Don't get ETFs.
Here's the thing is you can actually buy options contracts on ETFs as well, and that has treated me really well in the last few months. But it can also cause you to lose a lot more than you would otherwise. But the thing about ETFs is you really have to look at what they're comprised of. Some of them are super heavy on one particular stock or company, or even some of them are a mix of stocks and bonds.
Right.
And so you really have to look at what they're comprised of, because there are some out there that are super heavy. Some of the green energy ETFs are 10 to 15% into Tesla, which had been a great idea for the last 2 years, but Tesla is now seeing a lot of competition in the electric car market, and that market cap is being divided up, which is causing Tesla to sort of falter a little bit, which is impeding the performance of some of these green energy ETFs that are just heavy into Tesla stock.
So I would say, and correct me if I'm wrong, JP, but I would basically say if you're looking at managing your own stocks and if you're interested in doing this on your own, ETFs is a good way to do that. If you're talking your friendly neighborhood, financial advisor. I don't think you can get ETFs through a financial advisor. Can you?
It depends on what kind of a fund you have. If you have a 401k or a 403b, those tend to be, it's sort of broker dependent, but those tend to be more mutual funds. Some of them will allow you to do index funds. If you have an IRA account, I'm pretty sure you can do anything in an IRA account.
But depending on you don't have access to, I'm trying to think, you don't have direct access to trade via your financial advisor platform.
You can. There's just a commission involved.
Right.
I know with my financial advisor, it's like something like $14 a trade. So some of these day trades and short time plays that we make on Robinhood and apps like Webull, those aren't really possible or profitable to do through your financial advisor because you have that $14 fee. So I've made trades where I've only made $10 before, but $10 is $10. So that wouldn't be possible through an actual licensed broker. You'd have to pay them for that. So.
Right.
That's the difference. Is it's a little more expensive. You want to make sure that your plays are long plays and you're actually getting more than the commission will cost.
Okay. All right. Well, that makes sense. And good. So let's move on to let's move on to our final segment. We're about five minutes left on this. Next week picks. All right, so this is what we have here. I had to change my thing. I did have Viacom on there before we went on the air, and I had to update it because I don't think I'm going to be watching that. I'm probably going to try to get out while the getting's good. So
you can buy and trade all week and still be watching it, right?
That's true. Yes, that's true. Yes. All right. So next week. So this is what I'm doing. So I am going to be watching Acadia Healthcare and doing some research. I have some stuff on that. Is that it is one of the more accessible companies out there that provides mental health care. So, and I think as things are winding down, knock on maple, things are winding down on COVID-19. You're going to see a lot more people who are going to be looking for some mental health concerns. So I'm going to look at that. I'm looking at that. I see it's kind of been going steadily increasing over the last several months. So I'm curious to see what it's going to do next week as things speed up with the rollout with vaccinations. And JP, this is perfect segue into us just talking about ETFs. Yeah. What is Blackrock Innovation and Growth Trust?
So Blackrock Innovation and Growth Trust is a ETF that's similar to ARK Innovation, comprised of some of the same sort of technologies, but this one also includes some Bitcoin and some cryptocurrency holdings, miners and that sort of thing. Not necessarily the actual cryptocurrencies, but some of the companies involved in fintech and that sort of thing. This has not launched yet. I believe it's launching next week at an IPO price, initial price of $20. If it trends like other IPOs of ETFs, it's probably going to jump up 25 to 30%, and then immediately fall 25 to 30% from that $20, settle around, I'm guessing, $9. And then start to grow from there. So I am in. I have 20 shares of this for the launch. I'm going to wait a day and sell, and then I'm going to buy back in at the bottom, hoping it crashes. Now, because I'm doing that for viewers at home, you may want to look at just buying and holding, because if I'm going to sell the next day after it launches, that means that it's probably not going to drop, and it's going to continue to decline.
Just how your luck is.
This isn't any financial advice or anything. That's my experience.
I love watching some of these IPOs, and it's like was it Tuesdays and are they RPOs that are launched every day, or are there certain days of the week where they launch?
I really think it's dependent. I don't think there's any specific day.
Okay.
It just kind of happens whenever a company gets all their affairs in order, and they meet the requirements to launch with the SEC and with NASDAQ and everything, or the Dow Jones, depending on where they're offering, and it just comes out. And if you're in early enough, you can really make a good return. But oftentimes, what happens is the companies will price themselves so high, or I shouldn't say so high, but they'll price themselves at a level that's a little higher than what they're actually worth in order to raise money,
right,
to invest back in the company, and the price will settle down to something more appropriate to what they're actually doing for business.
Right. And yeah, and as I say, and just to remind people, once again, is that investing is accessible to everyone. You're all already experts in something, and utilize that knowledge you have, whether to be in gaming or writing, if it's books or gaming or comic books or toys or farming or whatever it is that you're really into. You already know more about that industry than the common person does, and you already know
who the leaders are in that industry.
Right. And once you start getting into investing by picking that one stock or that stock or two that of that company that of, and there's value behind that. That's when we mentioned before too, is like, then do some digging on who makes the batteries for that. Where is their product made? Who ships that product? Like, there's literally thousands of companies involved in that end product that you have sitting in front of you. So look at that.
The supply chain right down the line. If there's take for instance, I don't know, I think one of the best performing products this year has been the PlayStation 5.
Yeah.
It's selling like gangbusters. You can't keep them in stock, and they're selling for over retail price. But Sony isn't the one that's making the most money on the PlayStation 5.
Right.
The folks making the chips and the circuit boards and the all the way down the line, all the components involved in that. There are a plethora of companies making a lot of money on a product like that. Same thing with Apple. With Apple, it's pretty limited to Foxconn. They're their main supplier, but every single company has some choice suppliers, and those are the ones you really want to look at when you think a product is going to launch and be very profitable.
Right, exactly. I mean, you think about it too, is like you look at where you look at car companies. And we talked about GM before. You look at where those car companies come in, but those car parts are those companies that as you say are really making the best bang for their buck is off of those the people that provides the parts to those vehicles.
Yeah.
So yeah, and so good. So remember, everybody, it's investing is accessible to everyone, and so thank you very much for tuning in, and we will see you next week.